Ladies and gentlemen, welcome back. We hope you've enjoyed your coffee break. We are continuing with our program. I'd like to use the opportunity once again to thank all the sponsors. You see the logos on the screen as well. It's main sponsors, LGT Capital Partners, Questa Capital, Ernst & Young Fund Base and US Tax. Thank you very much for your contribution. The co-sponsors Morgan Stanley, Notenstein Privatbank, Schweizer Kantonalbank, the Business Network Club and Standort Höfe Kanton Schweiz. Once again, thank you very much for your contribution. We are moving on with our next presentation. I'd like to welcome Urs Wietlisbach. In Pfäffikon is co-founder and executive member of the board of directors of Partners Group. His presentation will be focusing on an asset class, on private equity. Thank you for joining us. I'll hand over. Thank you.
Okay, good morning or almost good afternoon from my side. Unfortunately, compared to most of our competitors, we are not in Pfäffikon, sorry, Standort Höfe. We are in Zug, but at least I live in Schindellegi, so I pay the taxes here. So you have something for myself. I was asked to talk about private equity. Where do we stand today? What are the special ways the private equity goes? But let me first maybe give 2-3 words on Partners Group itself. As I said, our headquarters is in Zug. We have 18 offices around the world, 750 people. We are one of the world's larger private markets asset manager with over 40 billion under management. We are as well listed on the Swiss Stock Exchange. Nevertheless, we consider ourselves a private partnership. As we still own all employees, we own over 50%, and 50% is on the stock exchange. And we run something which we call the integrated approach. So we invest every year about 8 billion for our institutional clients, of which 5 billion goes directly either into companies, equity or mezzanine. 2 billion is the secondary market, and a small part, 1 billion, is the so-called fund-of-fund market. Now let me first talk a little bit about these private markets. Lots of people, especially also in Switzerland, institutional clients and so on, they're all afraid and say, oh, private equity or private infrastructure, it's illiquid. I say equity is equity. If it's public or private for somebody who has a long-term horizon, as a pension plan insurance groups have, who cares about short-term liquidity? And you see a lot of examples in the meantime, especially the Canadian pension plans, who now in the meantime are seen, in my view, as the best pension plans around worldwide, with 10% over 15 years returns per year average. And such pension plans like the CPP, who is in the meantime one of the largest, about 220 billion on the management, they have in the meantime 40% in private markets, because they have realized, and the main reason, and you see one European insurance group has 60% of their equity allocation to private equity. So one has to ask himself, why do they now ramp up to such high numbers? And I guess the main reason is the performance. Private equity has, and there are now many, many studies done. Oh, this is one study out of it. The World Economic Forum has just done one. Private equity, depending on which study you look at, outperforms the public market between 4% to 6%. With a much lower volatility. Now, one has to ask himself, why is private equity outperforming? Equity is equity. A lot of people say, oh, that's nice, that's the illiquidity premium. But guess what? The illiquidity premium, this is just a wish. Something is not liquid, that's why you want to have a higher return. This is not the reason. The 3-4 main reasons I would like to elaborate, because this is quite important to understand. The first reason why private equity outperforms public equity is when and I take the examples which is close by here, Geberit. I mean, together with Dorothee Hansen invested in Geberit, who was a family-owned company. We did 6, 9, 12 months due diligence. We knew everything. We knew every pissoir in the inventory. So you know everything about this company. When you go into a public company, and if you know as much as we know at the time of investment, when you invest in a public company, you should go to jail because you are an insider. So we in private equity, because it's a private market, we can consider ourselves as legalized insiders. So if we do the job right, we should know more and there should not be any surprises after the investment. That's reason number one. Reason number two, I take here again the Geberit example, is that we are much better aligned with the management. We take the board seat, we usually have the majority, and the management has to come in with their own money. One of the former, he was not the CEO, but he was in the Geschäftsleiter, so he was a very senior guy at Geberit. I know him very well, and he went home after the negotiation of the deal to his wife and said, "My dearest, if this goes wrong, we are bankrupt. We have nothing left. I took all the mortgages up on the house and so on." So we usually want the management puts their own money in, not free options as you get in public companies. So story went very well. In the meantime, the person is very, very wealthy, but the company has done very well. They went public, everybody was happy, and we had good returns. And I'll give you here one example to show you about the corporate governance in private equity. They've been a listed company on the New York Stock Exchange in construction equipment. Great management, great CEO, CFO, great management, but a very lavish lifestyle because they were a public company. They had 2 corporate jets and all the goodies that you have in a public company, not all of them, but some. And we took it private, construction equipment, you can't do much. So what you can do is actually increase, hopefully, the EBITDA margin. And it usually starts at the top. So we took away, you don't need a corporate jet. You can lease one if you need one, if you have to fly somewhere. You don't have to stand around. So 2 corporate jets gone and all the goodies were gone. So we were able to increase the EBITDA margin by over 30% in 3 years, just by cost cutting, making the company better. Company was taken public again, and guess what? And it's still the same management, wonderful management. What was the first thing that the CEO did when he was public? Yes, he bought himself a corporate jet again. It's a true story and shows you the corporate governance. Now he has thousands of anonymous shareholders, and this is, I guess, one of this much better alignment and being close to the management is a main reason. Then the long-term perspective, we don't have to look at quarterly figures and so on, makes it much better to restructure a company when you invest. So these are, I guess, the main reasons that private equity outperforms the public market. Now let me also give you a little bit of hindsight from where does the private equity market comes from. It's actually started with KKR. Travis started it in the late 80s. And at this time, I guess many of you have seen the movie Wall Street, this was the first one, Michael Douglas. This is exactly how private equity worked at this time. You take a company conglomerate, remember the old days, universities told you to do conglomerates, go in everything that you can imagine and diversify a company. That we had a lot of conglomerates at this time in the United States. So what they did is they went, bought these conglomerates, put a huge leverage on. Arciano Bisco goes into the history as the highest levered transaction ever, 7% equity, 93% debt. And then they take it apart, the barbarians at the gate, sell the pieces. So this is where private equity, high leverage and taking companies apart. This was the start. But towards today, private equity has come into a mainstream asset class, and today, first of all, you don't have these conglomerates anymore because universities tell you today, go and focus on a single company. This is the reason that you don't have these conglomerates, and the second reason is you pay higher prices today and the leverage that you get is not so high anymore. There are always some exceptions, but in general, the last 5-year average leverage on the companies that we are invested in was 43% equity, 57% debt. This is what I learned once at the HSG. You should have about, depending on how cyclical it is, about 40% equity, 60% debt. So we can't do this high leverage anymore. The prices are higher. So where the market goes today in private equity is what I said before, together with the management, you really have to do operational value creation. Whenever we invest in a company, we have 2, 3 to 4 board seats, and together with management, we have a 100-day plan. We know what we want to do with the company. We find acquisition targets and so on. We have overall in Partners Group 7 different industry verticals. Each industry vertical has a former CEO from in the industry, like Media Telecom. It's the former CEO of Ringier before he was building up Bertelsmann in China. So these are really people from the operations, and together with the deal makers, they sit on the board and make sure that we can really make the companies better. That's what you have to do today to get to the returns. I give you one example. Trinco, that's a label maker. So when you have a Nike shirt at home, for sure the label in the back is from this Trinco, because they have 100% market share with Nike in the meantime. This is a wonderful company founded by a Chinese entrepreneur lady in Hong Kong, with a little in her living room, built it up to the leader in ASEAN. This company has 52% EBITDA margin. Can you imagine this? With this little stupid thing in the back, you make over 50% EBITDA margin. But this is the reason. This is not about printing this label. This is just-in-time delivery, because Switzerland and Germany has a different label, because the regulators tell put washing first and whatever after. It's amazing, but it has to be just-in-time. Now, making out of this company as the leader in Asia, we make now the global leader. Together with the management, she put 40% in again to the company. In the meantime, we invested 2 years ago. In the meantime, we have acquired Labelon in the UK. We have now production facilities, UK, Romania, Bulgaria. As we speak, we acquire somebody in Latin America. So we make out of a local leader the global leader in a very niche place, but with very high margins. This is together with management. Now, she alone, to be honest, would have not been able to do this, because this is as Chinese lady as you can be, especially successful Chinese lady. If she would have negotiated with this male 50-year-old UK sellers of Labelon, it's not a fit, would have not happened. So our UK office actually did the deal. The guys, sorry, they were all fired because they can't go the pace with her. But this is what we together can accomplish with such a company. In the meantime, I mean, the EBITDA margin, as you see, has increased by 40% through all these activities. I've seen Ernst & Young is here, so I stole something out of your brochure back from 2013 to come up with some of the myths that people talk about private equity. First, the myth is private equity is here to come in and take the company apart and lay off people. In general, private equity has actually, from this Ernst & Young study, you see they looked in the European private equity deals, we have been increasing employees in the average by 2%. The second myth is that private equity, as I said from the beginning, that they just take companies apart. Asset stripper, only 10% of the companies in private equity investments from whenever it was 2000, I think it's a 5-year period they looked at here in Europe, only 10% have divested the company, 90% actually did acquisitions. And the returns, as I told you before, through the operating involvement, legalized inside, being on the board together with the management, EBITDA margins were 7.3% higher from private equity financed if you compare industry to private companies. So I hope with this I can show you a little bit that this myth, and I still know, I mean, I know we have German, but it was not the politician in Germany who said the Heuschrecken. I have one here. Private equity is not Heuschrecken. Maybe hedge funds, I don't know, nothing against hedge funds. But private equity really together with management develops companies, and that's what we are all here for. Now a few talks about the growth of the alternative asset market, and especially here again about private markets. The biggest part investing in private or alternative assets, as we know, are pension plans and also high net worth individuals. And these are also the parts who are actually growing most. Let me start first with the high net worth individuals, because that's a little bit more tricky. So far, compared to hedge funds, where high net worth is a big part of investors in private equity, high net worth is still a very small part. Also from our assets, the 44 or 42 billion, about 2.5 billion is now high net worth. And the reason that high net worth is not investing so much is because we have hurdles to invest in private equity. It has to do with the structure of private equity. First of all, the minimum investment, if you want to go in our institutional funds, Partners Group Direct Equity, that's, you have to come up with 10 million. Not every private person can just put in 10 million. The second thing is, it's a very static asset allocation. You have no liquidity. It's a limited partnership for 12 years. And it's not very easy to administrate because you give us a commitment and over 3 years we can draw money from you as soon as we find the gabarit and have done the due diligence, and whenever we sell it we send the money back to you. So you have no clue when it's coming and it's coming back and whatever. So it makes it a little bit difficult. We have thought long about this and actually were the first in the market back in 2007. Great timing, 2007, at the top of the market, where we said we could also create a product which people are fully paid in. It's almost like a mutual fund, or it's actually a mutual fund, the CCAF structure. You pay in your money, you should be fully invested because you have such a deal flow that we can invest you on a monthly basis. You have minimum investment of 10,000, and when you want to go out, you can go out. Having said that, if everybody wants to go out, there's still private equity behind it, so there could be a gating. So far we never had to gate it, but it's possible, so nobody should think it's fully liquid. But it's somewhat liquid, so you can go in and out every month at net asset value. In the meantime, this has been growing to a substantial business. Overall, it's 2.5 billion that we manage in this kind of structures. And I guess one of the reasons is the returns. You see that it is, first of all, outperforming since whenever we started, February or May 2007, the MSCI World Total Return by 23%, which much lower volatility. That's the first good thing. And the second thing is as well, you see there is no the reason there is no volatility, I want to explain with the next slide. Public markets, even though people say they are always right, I say public markets are always wrong, because public markets are driven by sentiment. Look at the last, 18 months or 24 months, Standard & Poor's 500 increase is 71% multiple expansion, which I call sentiment. You think the world is great and nothing can happen, so you pay more for a company. And only 29% is actually fundamental driven, earnings increase. Funny enough, the markets still go up, even though all the analysts have actually earnings downwards revision. I don't understand it. People still buy the market. Too much liquidity around. So this is sentiment. It has nothing to do with fundamentals. If you look at this NAV increase here, underlying of the CCAF, it's just the opposite. In private equity, the way that we calculate the NAV is we take the latest EBITDA times a trailing multiple, not the multiple, the public multiple, the sentiment high multiple of today's market minus that. That's what the company is worth. This is why when you look at this fund, when you have their Greece somewhere in 10, 11, just because Greece goes bankrupt, Intel falls 30% in 1 week. Nobody knows. I mean, the public company, Intel, has not even sales to Greece. But nevertheless, the sentiment changes, multiple come down, earnings didn't go down, and that's why we didn't have any drop in NAV. That's kind of the difference on valuations between private equity and public equity. That's why you have less volatility. That's why I know I'm very, what do you call that, on one side, but I can tell the people, if you think that the markets are too high now in the public market, and you still want to be in the equity market, maybe you think about shifting part of it at least in private equity, because the fall afterwards will never be as big. We will go down. When earnings go down, we will go down as well. Now the second trend that we see on the institutional side is actually mandates. People go much more into mandates than into funds. Usually private equity, you put up every 3 or 4 years a new fund. and people come in there, but in the meantime, the biggest growth for us is that people say, we give a mandate out. A pension plan who wants to put 300, 500, 600 million into private equity or private infrastructure, whatever, they can't build up an own team because it would be too costly. CPP, I showed you before, they have 90 private equity specialists, same salaries that our people have. I know the senior management there, but they manage 35 billion in private equity. So there they can afford to have 90 people. Normally, if somebody has 500 million in private equity, 600 or whatever, can't afford these large teams. That's why they want to have then still tailor-made products for themselves. And that's the biggest growth for Partners Group. We can also implement the relative value approach, so overweight, cheaper years like 2009 through the secondary market. You buy all the funds because everybody else wants to run to the hills. You buy these funds, great funds, a big discount, so you can make an overweight for the inexpensive year 2009. You can only do this through mandates, and that's one of the reasons, I guess, that we see the move towards mandates. And I would like to finish with our view today of the private markets. What should you over and underweight? The first thing that we say is mid-cap makes much more sense today than large caps. Large caps are these KKR, CVC, Blackstone deals. It has never been such a big difference on entry multiples in a certain industry than between mid-caps and large caps as of today. In certain industries, this entry multiple is about 3 multiple points lower in the mid-cap side. Why is that so? Because the large companies, if you're a manager, CEO of a multi-billion company, you can go capital markets. You can go to the strange or the completely mispriced high-yield market, get a financing at 5.5–6%, which should be 10 or 11%. So the capital markets who are very hot today, you can go rights issue for a very expensive public market. So large companies can go public market, and that's the competition to the private market. Now try to be a mid-cap company, 200 million sales, 300 million sales. Try to do high yield, not possible. Try to do stock markets, not possible. Go to your bank and ask for more credit. The bank will tell you, oh, sorry, we're shrinking our balance sheets. If you're an IBM, they still give you money, but if you're a small 200, 300 million sales company, the banks are turning it down or definitely don't give you more. So the only place you can go is either private equity or private debt. This is the reason that you have this big difference on the entry prices. In emerging markets, we like investments in education, healthcare and consumers, because that's when you have a middle class growth. If you now go from a rural area into a city and you have now enough food and everything, then the next thing you want to have is education, and the next thing is healthcare, and then you also want to start to consume. Now guess what? If you go, the FTSE China is over 50% financials, the Brazilian Bolsa is 70% financials and commodities. Try to find an education firm listed in emerging markets. And if you find one, there are like 2 in India, they trade at 25, 28 times EBITDA multiple. So this, if you want to go into these sub-segments, the only place that you get in, somewhat decent priced, some places also too expensive, is actually going through the private markets. In the developed markets, because there is financing easy available, and the prices are here high, also in private equity, not only in public equities. Things that we like to do is platform building, so we have backed a management for schools. We just told the management here you have 200 million. They started from zero, and then are buying mom and pop schools. The first one they bought in Spain, now they buy one in the UK and so on. So this is what we do on the developed markets. And in Europe, to be honest, we are not very hot on the European overall development. Here we try to invest into companies who are cyclical resilient, like food and so such things. These are the main topics that we look at in Europe. I guess my time is up. Thank you very much. And I guess we are open for 1 or 2 questions. Thank you.
Thank you, Mr. Wietlisbach. We can take 1 question from the audience. Is there a question over there in the blue shirt, actually? on your left side.
Thank you. Can you tell us what kind of balance, cash balance you keep on the CCAP so that when there are net outflows, which might be caused by people requiring liquidity because the other investments have started to fall, can you offer? Thank you.
Yeah, good question. We are usually between 12 and 5% in cash. We have a small credit line which we only want to use if necessary, if we have the visibility. But it is true. I mean, I told before, I mean, we want to be fully invested, and it is true, it could be gated, so nobody should walk out here and think that it's fully liquid. The only reason that I can say is that we never had to gate the product. We have 3 here in Europe, we have 1 in the US. The US is over $1 billion. They went through these cycles. My reasoning that it never has been gated is if you put your clients into this fund, and your Nestle, which you have as a defensive stock in your portfolio, drops 30% back in 2008, are you going to sell this one who kind of is stable because earnings have not yet dropped? Stock markets usually go first and then a year later earnings come down. Usually you stay in, but I can't promise this, so could be well that you're gated for 1 or 2. But it's still better than being locked up for 12 years. So.
Okay, thank you. A second and last question. Is there anything you'd like to know? So, thank you again, Mr. Wietlisbach, for your presentation. Thank you. Challenges and opportunities of an unpredictable future. If the future would be predictable, Mr. Errol Billechen would probably not be with us, as he would offer other services. So he's talking about challenges and opportunities of an unpredictable future. He's head communications, institutional clients and asset management at Notenstein Private Bank. He has been working in the field of sustainability for almost 20 years. Thank you. I'll hand over.